Welcome to Bloomberg Markets. I'm Bonnie Quinn. Today on the program, all eyes on Nvidia as the AI chip giant is set to report earnings this afternoon. But first, let's get a quick check on these markets because we did see the selling pick up a little bit of pace mid-morning. As you can see, the S&P 500 now down more than 0.5%. The Nasdaq 100, though, and there's a story behind that we'll get to in a moment, down 1.1%. So pretty big decline for the Nasdaq 100. But remember, the S&P is still up about 8% on the year. The two-year yield just changed by about 4 basis points. We do get a 5-year auction out 1 o'clock. And then gold is about $30 off its record. So it's still up there, even though it's down about 0.7% today. It is late August, but there are still things happening. So let's get to some of those midday movers. Abigail Doolittle has details. Abigail.
Yeah, beneath the surface, Bonnie, we have quite a few decliners here for the tech space. You were mentioning that decline for the Nasdaq 100 down more than 1%. The S&P going solidly into negative territory. A big piece of it has to do with the chips. Now, yes, Nvidia, lots of jitters ahead of earnings tonight. But take a look at Supermicro Computers plunging 25% after having fallen significantly yesterday. And this plunge today, of course, comes on the delay of their 10K filing following Hindenburg's short report yesterday into all of this. This chip company had been up in a big way this year on the AI frenzy. Well, not so much. And it seems to be taking Nvidia down with it, not in the same way at all, down 2.2%. But of course, again, earnings tonight after the bell. And the comps that they're going up against are, of course, difficult on both a year-over-year and a sequential basis. So that could factor into how the stock reacts. And then sliding right along with the chip space, we have some of the mega cap tech names too, including Microsoft and Amazon. So the sentiment overall shifting toward the risk off. However, let's take a look at what is working, because there are stocks that are working. Idiosyncratic stories on earnings. Ambarella, the chip company, defying the chip weakness, up about 11% on the day. This having to do with a really nice quarter. A guide analyst saying AI and automotive could help them. Box, the internet app software company, up 8%. They beat. Billings were strong. The guide was good, and investors liking that quarter overall. Kohl's, this is an interesting one, because earlier it had been up significantly. Now it's up just 0.6%, but they put up a good quarter. Inventories are declining. There is a 36% bearish short interest on this one, so that's sort of an overall pressure, but I think folks are still hoping for that turnaround. We'll keep an eye on this one. The tape overall could be weighing on Kohl's, but one stock that is on the top of the pile is Berkshire Hathaway, so much so, in fact, that it has now reached a $1 trillion market cap for the first time ever. I really see Berkshire Hathaway in some ways as a proxy, Bonnie, for the S&P 500. Something that's worth noting about Berkshire, though, currently their cash holding is 45% of the portfolio. They, of course, are not market timers, but over the last 6 to 8 months, they have been selling Apple. It's still their biggest stake, but they've been selling it. You have to wonder why they have so much cash. Yes, interest rates are high, but are there some sort of storm clouds that, again, not market timing, but are just sort of coming through in the portfolio? Either way, this stock doing very well, a $1 trillion market cap.
Yeah, they haven't been able to find opportunities for years now, right, Abigail? It's not just in the US, but Europe, Asia as well. That's Abigail Doolittle there. Thank you. We'll take a look at the overall market. John Hancock's Emily Rowland spoke earlier on Bloomberg about where we stand now as we close out August.
On one hand, the market's pricing in this soft landing scenario, which, by the way, has been helped a ton by a weaker dollar on the idea that the Fed's going to be cutting aggressively. That's actually helped cyclical assets outperform. This quarter, those risk-on asset classes have actually been the winner. But then at the same time, you have other market participants pricing in this, bad news scenario with areas like gold and long-dated treasuries outperforming. So we're in this very strange period right now where the music's still kind of playing, but everyone's not quite sure when the record might stop.
For more on these markets now, we're joined by Amanda Agati. She is Executive Vice President and Chief Investment Officer for PNC Financial Services Asset Management Group. Amanda, thank you so much for joining. Let me ask you, given that we picked up the selling mid-morning, is this market in trouble if Nvidia doesn't impress investors later on?
Well, it's great to be with you. Thanks so much for having me. I I don't want to put all my eggs in Nvidia's basket here, but given the size of the exposure in the index and given the expectations going into tonight, it certainly is going to have a material impact one way or another on how results play out. And we're not feeling particularly concerned about the results going into tonight. The SMC noise and news over the last day or so seems completely disconnected from Nvidia, but of course, a lot of investors, I think, are kind of holding their breath to see how results turn out this evening.
Well, for those trying to make sense of this market, September generally isn't the best month for equities anyway. So if you had gone away in May, would it be prudent to maybe just stay away a little while longer?
You're right. September is not one of our favorite months from an investment perspective. We've been fully invested. We've been riding this wave for the last few years here, even in the face of potentially, a harder landing scenario that failed to materialize. Now a soft landing scenario and a couple of corrections since May here. So we're not feeling particularly defensive or bearish going into the end of the year. But I think investors really have to understand that the dynamics in the second half are going to be very different than the first. It's going to be a choppier environment. It's already been choppier since we hit the mid-year point. And so, of course, we have Fed rate cuts. We have Q3 earnings season. We have a big election coming. There's a lot of things for investors to wrestle with into the end of the year.
And so it's fascinating then that you're fully invested and have been fully invested. Can I ask where, Amanda, and where is the ballast for your portfolio?
So for us, we've been making tweaks at the margin, though staying fully invested. And it really is a theme of focusing on quality. We're really focused on quality exposures, both in equities and also in fixed income. We've also had to create a little bit of ballast, some minimum volatility exposure that was very beneficial in the swoon that we saw earlier in August. And so there are some opportunities at the margin to create some insurance and ballast in equities. Some of these names and some of these exposures haven't really participated to the same degree that, let's say, the Magnificent Seven have. And so there is a slight valuation opportunity, but nothing in equities is really table pounding cheap here. And on the fixed income side, we've been leaning away from below investment grade exposures in this environment. It's still late innings. And though we think we're going to engineer a soft landing here, we think investors aren't being paid to take on the risk in some of those areas of fixed income asset classes.
It sounds like you feel like the market is fairly well priced at this point. Why would you not be keeping a little bit of powder dry in case there is some kind of sell-off in parts of the market?
Well, we always have a little bit of cash on hand, but I think cash is the world's worst investment. It's not an investment. It just creates a little bit of optionality. So we do have some optionality sitting in portfolios, but it's not a big balance relative to history. And I think we're just kind of waiting to see how some of these key data points come in over the next couple of months, and certainly what happens with the next earnings season to take our next big move. Particularly in the face of a big election that's coming, it's very hard to get on one side or the other of a binary outcome. And so that's not how we manage money. We try to stay pretty well diversified. And so going into some of these events in the second half here that are likely to create some volatility, we think the best way to play it is stay invested, but stay fairly well diversified.
Now, you say you're hewing to value for the most part. What is considered value these days?
It's a hard question to answer, actually, right? But I think from our perspective, we do see some more opportunities in the more traditional value-oriented or cyclical side of the equation. It's hard to back up the truck in aggressive growth, right? It's hard to back up the truck in technology and communication services here. We're happy to have those exposures, but I think if we're going to put capital to work, it's really looking in the more value-oriented cyclical side of the equation. And dare I say, maybe even some of the smaller and mid-cap parts of the marketplace. It feels a little early. But if we're going to get some tailwinds from Fed rate cuts into 2025, I think there's some really interesting opportunities in those areas of equities.
Aren't we very dependent on the consumer for those kinds of areas, Amanda, or at least more dependent than we are in some of the other areas? And if that's the case, should we be concerned about a consumer that's concerned about the labor market, even if the Fed isn't all that concerned about the labor market?
Oh, absolutely. We're always concerned about the health of the consumer in good times and in bad. The consumer has been the bellwether, the tailwind for the economy for years and years, and certainly in this post-pandemic environment that we've been in. I think a key data point for us is certainly what the back-to-school season looks like. What are consumers doing in terms of their spending habits? We've seen a few missteps in the last few retail sales data points, but it's still holding up okay. It's late innings, and so we're expecting consumers to trade down. We're seeing that trade down. They're still very focused on services, but I think we'll get some more interesting, data points in terms of a gauge on the health of the consumer just in the next few weeks and months. But we think the consumer is going to hang in there. Okay, it's been a tough slog, and they're certainly getting tired, but we think the consumer is still hanging in.
Well, they certainly have some confidence. Whether they'll act on it or not is another question. Amanda, thank you so much. That is PNC's Amanda Agati. Coming up, Super Micro shares tumbling today after the company said it will not file its annual fiscal year report on time. This, of course, just after the Hindenburg research report as well. We'll bring you details next. This is Bloomberg. This is Bloomberg Markets. I'm Bonnie Quinn. Now to a Bloomberg News exclusive. The billionaire founders of Two Sigma, John Overdeck and David Siegel, are stepping down after feuding for years. They're handing control to two new co-CEOs. Let's get the details with Bloomberg hedge fund reporter Hema Parmer, who wrote the story. So they've been feuding for years. Did something extra happen that they finally had to be told, guys, enough?
I think things had built for so long, and the firm, it got so bad that the firm actually, in a regulatory filing, disclosed that this was a material risk, that the two billionaire founders were disagreeing on so many things that it could pose a risk to investors. That sort of shows how bad it got, that a very secretive hedge fund would take such an unusual move. So then, clearly they needed to resolve this matter in some way, and they even disagreed over succession planning. So and somehow the two agreed to step down and hand the reins essentially over to two new CEOs.
Yeah, we'll get to them in a moment. I could see how you would disagree on succession planning. That's a tough one, right? But did it extend to actual strategy disagreements, or was it more the day-to-day operational and maybe personal disagreements?
Yes, it was operational issues. They disagreed over how the firm should be run, the roles of some senior executives, structure of the firm, succession. But keep in mind, this is a quant fund, so essentially they set up models and they have teams of people that work under them. So the actual investment choices are not necessarily left up to the people running the firm per se, but a lot of the firm is managed, at the top in some ways. So it is a significant move. You don't want your two founding leaders of the firm feuding, and it actually did impact some employees' ability to have initiatives go underway. For talent to attention, it can be a problem as well.
For sure. Now, in terms of strategy, they will still be having a say in strategy. So if you're the management committee, how do you prevent that from spilling back over into sort of day-to-day business?
Yeah, so day-to-day management is going to be handed over to the new two CEOs, but the founders do still have a sizable equity stake. They are still co-chairman of the firm, and they are the two biggest investors in the fund. So they will still have some say and influence. They will be able to oversee or guide the firm, but they may not have as much day-to-day management of the firm responsibilities, because that was impacting the ability of staffers to implement the things they needed to implement. So hopefully this should streamline that better.
What is Wall Street saying about this? I mean, there are so many lessons in here for other hedge funds, right? Especially hedge funds that try to diversify the top of the ticket, right? Maybe not just have one person. Did anyone try and advise them get over it?
So, succession planning in hedge funds has always been a struggle. You look at a lot of the very big hedge funds, a lot of the titans at the top, they struggle to figure out who should take the reins, if they even want to step down, how to restructure a firm, and how to keep the firm still as successful as it was, even with the person at the top no longer there. So you see that across the board. And in this situation, too, you see clearly that there was some struggle. The two new CEOs are not typically quanty in the way you would think of someone running the top of a quant shop like these two gentlemen were. So it's definitely an interesting move, but also not an uncommon struggle in this space.
Now, the two new co-CEOs. It's interesting. One was the Chief Business Officer, Carter Lyons, and the other is going to be the former Lazard General Counsel, Scott Hoffman.
Yes.
So definitely a legal mind and maybe somebody who will get in new clients potentially, right? The business officer, is that the reasoning behind the two co-CEOs?
It looks like there's some new blood with the new voice, some tenured staff there, a bit of a, not traditional, what we might think of as like somebody who has done PhDs in quantitative studies, which is typically the types of people who run quant firms or start quant firms like these. But, it does shift towards a team that at least should work together, like each other, not be feuding.
What do we know about people who have left, not in management ranks, but maybe below that, or people who have joined recently?
So they've seen some departures in recent months and over the past year or so. The firm's performance has generally been okay. What's interesting is even though with all of the public feuding, with all of the news around this firm that's been going through a pretty difficult time, their redemptions have stayed essentially the same. They haven't seen a mass exodus of clients given the wake of this news, and over the past year or so, assets have stayed roughly the same, and their performance has stayed roughly on target and the same too. So you haven't seen a material impact necessarily on assets or performance.
Just out of curiosity, roughly what percentage of the assets belong to these two?
It's unclear the exact numbers, but sizable stakes.
Yeah.
They both founded the firm, basically control the firm. So in equity, they have almost, I think Overdeck has a little bit more than David Siegel, but it's sizable and it's pretty much close to split. And any big decision that the firm makes, they both need to agree on it. So you can imagine then if a firm is looking to make decisions and they don't agree, how that could impede progress.
I cannot wait to read the book when this comes out eventually. Hema, thank you so much. Great reporting. That is Bloomberg's Hema Palmer there with an exclusive. Coming up, a touchdown for private equity firms looking for a stake in NFL franchises. We'll break down the fallout from the historic owners' vote. This is Bloomberg. Much of the sports world buzzing today as industry leaders digest the results of this week's NFL vote. Team owners voting to allow private equity firms to buy stakes in their franchises. It's a move expected to attract billions in fresh capital. Boston Celtics co-owner Steve Pagliuca weighed in on the decision earlier on Bloomberg.
People are confused a little bit in that the private equity model applied to the NFL or applied to the NBA is very different. It is more, I would call it investment fund policy rather than private equity policy. Classic private equity firms go in and buy companies and then try to grow them and grow the revenues and earnings and globalize them. That's not the case with sports investments. Sports investments will be done by specialized funds like Arctos, Dial, already in existence today. And they take limited partnership stakes, and they're limited to 10% in this NFL deal, I think 30% in aggregate in the NBA deal. And those would be passive stakes, really made to open up the market for folks that want to invest in sports properties. And they've created an asset class. So it's a little bit of a misnomer to say it's private equity buying in. It's a passive limited partnership position so that more people can have access and have capital into the booming sports business.
Joining us now for more is Randall Williams, Bloomberg News U.S. sports business reporter. He was in Minneapolis covering the vote yesterday. So, Randall, give us the skinny. Who was there that we mightn't have anticipated would be there in terms of potential owners?
Oh, Clark Hunt was there. He's the leader of the finance committee. Jerry Jones, Josh Harris. There were a lot of NFL owners who were there present. This was a pressing issue, and the league wanted to get it done before the season starts next week.
Does this mean there are going to be a lot of new stadiums around the country over the next 5 years? Is that essentially what it is, money for stadiums?
Well, stadiums are definitely going to be a part of it. Clark Hunt said that outright, that there are going to be some owners who need this money to build a stadium. And it isn't just building them, it's renovating them as well. And then there are some owners who have succession issues, who want to shave off some of these things where their children may deal with estate taxes. There's other issues where maybe a lawsuit is happening amongst siblings.
Now, private equity, there have been, several funds sort of already greenlit, if you like, to be bidders. But will they want their pick of the teams, and how is that going to work? Will they all be vying for the same one or two teams?
Well, the interesting thing, the way it was described to me was that this is like the pre-tampering period in the NBA. And what that is when NBA teams and the players are allowed to negotiate with each other. So that's what's going to be happening between the NFL teams and these firms over the next couple of months. Is the firms are going to reach out to the teams. The teams are going to try to find the right fit with the firms. I think they all have a different expertise in a way that they want to go about this. So we'll find out over the next couple of months.
Well, that's just the thing, too. Is it just about money and who gives the best bid? Or do these private equity funds have a say in day-to-day operations or in who gets picked, for example, or anything like that? And if not, surely it is just about money.
No, this is a capital thing. These private equity firms will have no decision-making. I saw yesterday on Twitter there were some fans who were going rabid about how this is going to ruin the NFL. But the reality is that these firms are coming in with the purpose to buy and help these teams pay for things and find solutions where they may not have them without some of this money.
And correct me if I'm wrong, but for the NBA, it can be up to 30%. Here we're talking about just 10% maximum.
Correct.
So then what happens next, given that we're in a pretty mature business here?
Sure.
I mean, the NFL has seen a lot of growth. Valuations are sky high. Can they get higher? Is there more to grow?
That's what the NFL commissioner thinks. That's what many NFL owners think. The valuations are going to continue to rise and that this is going to help push them. The private equity part of this is going to be interesting. There are multiple league executives that I've spoken with, as well as team executives that expect a lot of deals to happen very quickly. People are ready to get some of this money and put it to use.
All right, give me the top 3 teams that you think will be going first. We need a hard knocks on this. That's what we need.
The top 3 teams. Well, the Buffalo Bills already have a stake up for sale. The Los Angeles Chargers have a stake up for sale. And our very own Jillian Tan reported that the Philadelphia Eagles, Jeffrey Lurie, is exploring a stake sale. So those are the 3. The surprises, I think, hopefully we'll be breaking those. Exactly.
Can't wait to follow this story as it progresses. Randall Williams, thank you so much. And of course, all the team that contributes to all of these stories. Let's take a quick look at where we are now as we come up towards lunchtime markets-wise. We had been selling off just a little bit in the early going, and we had chip stocks in particular dragging on the S&P and the Nasdaq 100 in particular, as you can see, continuing that trend now, down 1.4%. We have the S&P 500 down 0.75%. And as you might imagine, just a little buying in bonds. That auction coming up in about 35 minutes. That's a 5-year auction. We'll see how that's received by the market. And then, of course, we have gold still very close to records. We're about $30 off the record for gold. So correlation still in this market for risk on and risk off assets, interestingly enough. I'm seeing natural gas has changed its direction. It's up about 2% now, natural gas. And oil, we saw a little bit of a sell-off in oil earlier, even as geopolitical tensions and Libya continued to dominate the narrative there. But we're trading at 78.86 for a barrel of Brent now. Coming up, we're going to talk about Super Microcomputer delaying a key filing. The stock falling a lot today. Stay tuned. This is Bloomberg. Welcome to Bloomberg Markets. I'm Vonnie Quinn. Tech dragging U.S. stocks lower as investors await Nvidia's earnings after the bell. Let's get a quick check on these markets now. The S&P 500 not down by as much as the Nasdaq 100, but still down about 0.7%. Lower volume, of course, at the end of August, but also jitters for sure. As you can see, the Nasdaq 100 being dragged down by the chip shares. We'll get to those in a moment. 5-year yield at 3.66 before that auction taking place in just about 30 minutes. Not many people around, but I suppose those that are interested in auctions will definitely be at their computers. And we've just broken the 2,500 mark now for gold. It is down about 1%. Don't let that fool you, though. This is not a calm market. Let's get to those midday movers now on the equity side with Abigail Doolittle.
Yeah, lots happening beneath the surface here, Vonnie. If we take a look at technology in particular, that's really dragging on that Nasdaq 100 that you were mentioning, down more than 1%, but also dragging on the S&P 500. Nvidia in particular, the worst point drag for those indexes. Jitters ahead of earnings. Lots of volatility on the year, but the bottom line still up more than 150%. So price to perfection. It's really a case of expectations. Options suggesting there's going to be a 9 to 10% move up or down. One thing I would point out here is even though they will put up tremendous growth on an objective standpoint, when it's looked on either a sequential basis, when it's looked at it on a sequential basis, frankly, it's not going to look nearly as good. So it'll be interesting to see whether or not that weighs in. But we can see Broadcom down, Microsoft, Amazon. So a little bit of a risk off, or quite a bit of a risk off sentiment next to or around technology. If we take a look at our next earnings movers here and move to the retail space, Kohl's back in the green and solidly so, up more than 2%. They put up a nice quarter. They raised the view. Inventories are better. There is a 36% bearish short interest there. So some of their bears deciding to get out, but it's been all over the map. Chewy really up sharply higher, up about 16%. There's a 13% bear short interest there. So it seems that while they did beat in a big way on earnings, the actual number not so big. I think it was 24 cents versus, actually, I'm going to bring that back, but they did beat on an absolute basis in a big way. The number itself not huge, but it seems as though the results in some of the categories that were strong enough to scare some of those shorts out, maybe attract buyers as well. Foot Locker, not so much. They put up the first positive comp in 5 quarters, or after 5 quarters of declines, but it wasn't enough because out of the spring bottom, this stock up more than 65%. So price to perfection, and they didn't quite deliver it. Now, if we turn to Abercrombie and Fitch, this stock having its worst day since, I believe it is 2022, down 17.8%, even with this decline, because this is another example of expectations being very high, priced to perfection, too far, too fast. Even with this decline, still up more than 55% year to date. They put up a great quarter, but investors wanted more given that move. And then, speaking of moves, Bonnie, let's take a look at the shares of Supermicro Computer, because they are in a league of their own, the worst since 2018. Over the last 2 days, down 29%. In fact, on Monday, down 8%. So over the last 3 days, down close to 40%. The better half of better portion of 40%. And having to do, of course, yesterday, a Hindenburg short report. Today, they're delaying the filing of their 10K. Investors that had scrambled to be in this stock on the AI craze now scrambling to get out as they figure out what is actually going on there.
This is so fascinating, Abigail. Thank you so much for that. Bloomberg's Abigail Doolittle. Well, I want to dig into both of those last names, but let's start with Supermicro Computer. A really, really fascinating story. It was trading above $1,200 just a few weeks ago, and as Abigail was saying, it's going to delay the filing of its annual report for the fiscal year ending the end of June. Before we start, I do want to point out that the sole communication from SMCI on this is a spokesperson telling us the company, quote, does not comment on rumors and speculation. And this was, of course, after Nate Anderson's Hindenburg put out that report because of, quote, glaring accounting red flags, among other things. Here with more on all of this now is Bloomberg's Brody Ford. So it seems like yesterday investors were, perhaps at least by the end of the day, willing to give SMCI the benefit of the doubt, or thought maybe we already knew about some of these implications of Nate Anderson's report. Today, it's a different story. Very strange timing that they're suddenly today delaying this report. Is it a coincidence?
Yeah, as you said, it's interesting because they've had some well-documented and settled accounting problems in the past. So I think some investors saw the Hindenburg report and said, we knew this, so it was already priced in. Then today they say they're delaying their 10K. I mean, that is not a step companies take lightly. A company of that scale delaying its financial reporting, I mean, I think we've only seen 2 other companies do that this year in the S&P 500. And so why are they doing it? They said they are doing it because they are looking into their reporting processes. And crucially, they seem to leave open the door the possibility of some financial restatements. They say we are not changing our financials. They're not saying we do not plan to, which you see that language in some other reports like this.
For sure. There are also the questions surrounding doing business with sanctioned entities.
Yeah.
What more do we know about that?
Yeah, in that case, we don't know a ton outside of the Hindenburg report. That was not a huge focus of the delayed financials today. The Hindenburg report alleges more issues around recognizing revenue a little earlier than you're supposed to. The phrase you hear sometimes is channel stuffing, where you send things out to partners that aren't really able to sell it yet. The delay today, they didn't acknowledge any of those allegations, but they said, we're looking into our internal processes, which can let the investor mind wander, as we're seeing with the numbers today.
Absolutely. Now, is it possible that in the next few days they'll say, okay, we changed a little bit of the language, we ran it by legal, and we're good to go?
It's possible. Again, if it was a very minor thing, companies really hate delaying their annual forecasts. They hate delaying their annual filings. I was covering a company earlier this year that delayed their 10K, and what happened was they fired their CFO and activist investors got involved. Often, when you see some smoke like this, you're going to end up finding some fire.
They also have really just announced in the last quarter a stock split coming up, right?
Yep.
And they're getting back into the NASDAQ. So it's really bad time for this to be happening for them. Not that there is a good time.
There might be that phrase suffering from success, right? I mean, they have quintupled in value over the last 2 years.
Not
and
anymore.
So I think they're still like
still
4x
up about 45%,
right?
yeah.
I mean, over the last, since beginning of 23, beginning of ChatGPT mania, I mean, it's still on the long scale success story, and that's why investors are so ready to kind of poke little holes if they see any errors here.
Well, and that's the other thing. I mean, it's a server company, right? I mean, it's a pretty simple. I mean, not that I would be able to run it, but it sounds like a pretty simple, pretty easy to run. And if they have a lot of market share already, which they have from some of the big guns, or they had at least from several of the big guns, I mean, shouldn't this be a pretty easy company to keep rolling?
Well, you got competition now. You got Dell, you got HPE. As you said, building a server isn't the most complicated thing in the whole world. As long as you're getting chips from Nvidia and you got a good labor pool to build them, it's something that, you know, your competitive moat might not be incredibly strong, right? We've seen squabbles for, who is going to sell servers to Elon Musk's companies, for example? Who's going to sell servers to Meta? These kind of giant companies that require crazy number of GPU-based servers.
Well, the stock has tanked more than 25% so far today. Could Jensen Huang say something about this, or will he stay well away?
Interestingly, he has more spoken about Dell. It's generally thought that Dell and Supermicro are the kind of biggest server partners of Nvidia. They've traditionally spoken more about, he said, Michael Dell is the greatest, maybe that was a bit of a, forward thinking on his part. Maybe he saw some of these issues. It's hard to say. I would be surprised if we saw more from him tonight about Supermicro.
It's another win for Hindenburg, right? I mean, so far, yesterday investors were not willing
I'm
to
sure they're doing cartwheels right now.
I bet they are. All right, Brody, thank you so much. That is Bloomberg's Brody Ford.
Thank you.
Turning now to Abercrombie & Fitch, which boosted its full-year forecast and beat on earnings per share pretty substantially, but the stock down as investors raise the bar for the retailer's outlook. For more, let's bring in Bloomberg's Mary Ross-Gilbert. So, Mary, I looked at the results and I thought, wow, and then I looked at the stock reaction and I thought, what do investors want?
Well, actually, sometimes that can happen, and then, days later, you could see the stock reverse, or maybe months later. In this case, as you pointed out, they've had a nice run up this year, still up, over 50%. But if you look back over the last couple of years, you're talking about many multiples up. And that reflects the strength of the brand. But if you also look at consensus expectations going forward, they're looking at more tepid increase in sales, because how can you keep posting double-digit increases on double-digit increases? Which, of course, in the second quarter, we saw comp sales up 18%. Which was pretty strong, and that was led by Abercrombie up 21%, Hollister up 15%. But this company is very in touch with their core millennial customer on the Abercrombie side, Gen Z on the Hollister side, and so they're constantly expanding categories and assortments with very attractive and compelling product. Every week they have drops, whether it's a Western aesthetic, the new NFL lineup that just came out now, and then also they'll have, across their wearing occasions, we hear a lot about the wedding shop, best dressed guest, and also even, for the office, they even have some silhouettes for that, and even cute Chanel-ish type looking, short knit dresses. So they really are catering to their consumer. They have a strong activewear business that's growing as well. And they really, I think Fran talked about how they test and learn and expand, and that's what you're seeing from them. And we think they can continue to do this. So we think they're showing strength.
Have they, Mary, put to bed all of the problematic issues of the past? And we've seen a real fallout across retailers, everybody from Brandy Melville to Reformation. You know, so many of the retailers just couldn't stop walking into glass, right? Of their own making, these were problems. Has Abercrombie overcome all of that?
For the most part, they have. I mean, it's a completely different retailer than the retailer we knew of years past. So this transformation is very real, and they're really catering to a different consumer, and it's that millennial. And the other key point to note is that their consumer base for both brands, they're from household incomes that make $100,000 to $150,000. So they're in a much stronger position than some of the retailers that are catering to a lower income. And that was sort of confirmed yesterday when Nordstrom came out with their numbers, and their full-line stores showed a modest increase, almost a 1% increase in comp sales, but very strong sell-through of regular price assortments there. And they're constantly bringing in new brands within Nordstrom. And of course, they have the fast-growing Rack, which is in the off-price segment, and that spans the income demographics there, including the high end. So I think we're seeing strength in the high end, and we're seeing weakness in that sort of lower to middle and middle income consumer. And that's where we're seeing, you know, the tough results, for example, out of Kohl's today. Even though Kohl's beat on the bottom line and raised their EPS guidance for the full year, their sales came in short. Actually worse than expected. They were down 5% on a comp basis, and analysts were expecting down 2.5%. They need to redo their apparel assortments because their core apparel and shoes underperformed, but they had strong performance with Sephora, bringing in new customers, and those comp sales up low teens there. So they are showing things that are working, but more work to do.
The retail quarter has been fascinating. It always is. You never know who's going to outperform and underperform. And it's not over. We still have Gap and the likes of Best Buy as well to come. Mary Ross-Gilbert, thank you so much.
Thank you.
Coming up, we're going to concentrate more on Nvidia earnings, which could shape up to trigger a market event. We'll discuss next exactly what the street is watching for. This is Bloomberg.
Definitely see some sharp deceleration in terms of the data center capex spend. I mean, we're looking at about 35 to 40% growth here in calendar 2024 from kind of the big five spenders out there. We know who they are in terms of the hyperscalers, the big four plus Oracle are the names we kind of look at.
That was CFRA's Angela Zeno speaking about Nvidia's capex spending. Time now for Stock of the Hour. Nvidia expected to report earnings today, with investors anticipating strong results. Either way, though, the results and guidance might constitute a market event. Joining us with more is Keybanc Capital Markets Managing Director John Vinh. He has an overweight rating on the shares, as do so many analysts, John. It's really quite phenomenal. Analysts are still very, very bullish this name. We need an update on the Blackwell chip delay. What will Jensen Huang be able to say to reassure markets? Will words be enough?
I think they're obviously going to be questioned quite a bit on a year's call. I do not expect that Nvidia is going to explicitly talk about the timing of Blackwell. We think there's roughly about a modest delay, about 3 months. But where I think they'll get pushed if they don't respond to specific questions on Blackwells is what they're going to say about kind of the Q4 outlook. Obviously, they're going to report July quarter. They're going to guide to the October quarter. Blackwell isn't really supposed to ship until the end of the October quarter, so it should not have any sort of impact on near-term results. But if Nvidia can come out and say that they're still expecting strong growth in Q4, that should alleviate some concerns about the impact of this Blackwell delay.
Another concern has been about margins. So we saw not a great reaction to earnings last time around, because even though it beat and it was doing really, really well, margins were not, as much as Wall Street would have liked to have seen. What can Nvidia do to compress margins more?
We actually think that margins are going to be biased to the upside in the near term. So what happens with Nvidia is when they launch a new GPU family, let's say Blackwell, in the early part of the ramp, the margins are just not optimized because they're going through the maturity yield curve and they're optimizing manufacturing processes. But here, they're going to be shipping Hopper GPUs, which are kind of late cycle. So the margin should actually be very well optimized here. So I actually think margins are going to come through in flying colors.
The forward multiple has compressed, right? We were at 60 at one point. We're now at 38. What is fair value? Are we still sort of involved in price discovery here?
We've got Nvidia doing 516 in EPS next year, which means the stock's trading at kind of a 25 multiple historically. Nvidia's traded at 35 to 40 times. The broader group trades in kind of the low to mid 20s. I think using kind of a 35 to 40 multiple is the right multiple for one of the best positioned stocks to be leveraged to generative AI, which gets us to our $180 price target here.
Yeah, and that's also stunning. 66 buys, just 8 holds and no sells among the analyst community. And more than a third of the buys are targeting a stock price above $150. Obviously, you're among them. What would cause analysts to have to recalibrate?
I mean, I think there's a number of potential risks out on the horizon, right? One is right now they've got dominant share. It's 90% plus. Hyperscalers are looking for alternatives. The alternatives are internal hyperscaler design solutions like custom ASICs. Google has their own with the TPU. And then there's merchant solutions. AMD is ramping their MI300X GPU. It's doing quite well, but the share is very small. So obviously, if those two opportunities were to gain greater share, that potentially could create risks and headwinds to Nvidia's growth longer term. And then also in China, Nvidia today is still shipping a compliant GPU that's compliant to our export controls as determined by the US government. It's the H20. There's some concerns out there that there could be further restrictions imposed by the US government. And if that is imposed, that could obviously impact some of that revenue and earnings growth going forward as well.
For sure, election risk out there. John, thank you so much. Nvidia has beaten 5 quarters in a row now. Let's see how long it can continue the trend. John Vinh there over at Keybanc Capital Markets. And make sure you stay tuned for Bloomberg's extensive reporting on Nvidia's results today, including an exclusive live interview with CEO Jensen Huang. That's set to air 6:30 p.m. New York time. It's a Bloomberg Technology special, and you won't want to miss it. Coming up here on September 1st, Texas will open its new business courts. That's a move the state hopes will draw companies from Delaware. Will it work, though? We'll discuss next. This is Bloomberg. This is Bloomberg Markets. I'm Vonnie Quinn. Can Texas unseat Delaware as a hub for business-friendly courts? Well, after Elon Musk's Tesla compensation package was turned down by the Delaware Chancery Court, a massive effort has been underway to build a similar system in Texas, and it's due to open September 1st. For more, we're joined by Bloomberg's Julie Fine. So, Julie, it seems like it's all because Elon Musk wants his pay package reinstated, right? But this has been a little bit of an impetus for a while now in Texas. Tell us more.
This has been in the works for a while. Obviously, Elon Musk coming here brings much more attention to it. But listen, Texas considers itself to be a very business-friendly state. Having these courts, is almost like a marketing tool, saying you can incorporate here. We will now have our own business court system, and you can develop it in certain ways. For instance, it's the governor right now who is appointing the judges to these business courts. So it certainly gives businesses an option to incorporate here and take care of major business disputes in this state.
You just gave away one of the challenges, though. Administrative people, clerks, judges, they're all only getting appointed right now, even as Texas has 5 business districts, just sort of announced these 5 business districts. If you were a company or a chief legal officer, why would you give the advice to go to Texas when Delaware is right there with all of the experience, the speed?
Well, I think there may be businesses that feel that it will be more business friendly in Texas. You do see private equity firms here coming to use the federal courts because the appeals are in the 5th district, and that is known as one of the most conservative in the country. So I think in that respect, you may see some come here. However, there are some major differences that will have to be ironed out. For instance, in Delaware, when you look at the court officers, they are coming from some major legal corporations. Some of the decisions will be decided by juries here in Texas. So Texas will have to work hard to get the word out about these courts, and they will have to show some success early on. Now, currently, right now, they don't have some staff. They are working out of state courtrooms. There are no specific buildings right now, so there's certainly a long way to go.
Yes.
But I think when it comes to Texas, which is very business friendly, this is another way for the state to point out that.
Well, Greg Abbott, the governor there, is going to do his level best. Our thanks to you, Bloomberg's Julie Fine. A great story, and we will continue to watch it. Let's take a quick look at these markets now as we head towards that 1 o'clock hour. We are off our lows, so the Nasdaq 100 is down about 1%. A lower volume day, though, of course. Do stay tuned. That does it for Bloomberg Markets. This is Bloomberg.